Welcome back to Inflation Decoded and Explained. Is the stock market a perfect inflation hedge? That's the question we're gonna analyze today. We're going back to the 1970s to look at how the stock market reacted, and we see whether we can learn something from that period. I can tell you already now, they are very interesting and very important lessons learned from back then. So let's first start with my inflation management system, which I developed a while ago. It's the so-called 4 phases inflation management system. If you want to read about it, it's all in my book. I will very briefly go over it because you need it to understand how stock market and inflation are connected together. So in the inflation management model, we have 4 phases. Each phase needs its own strategic response. Now, I developed this management model to help CEOs and CFOs to manage their businesses during times of high inflation. Every phase is totally different. If you have the same strategy for phase 1 as you have for phase 2, you might be in deep trouble. Let's go through it. The first phase is the pre-inflation period. In that period, everything seems fine. The economy is booming, interest rates are low, inflation is low, and the stock market is doing pretty well. Interest rates give a further push to it, and everybody is happy. Then comes phase 2. Almost always in history, phase 2 is the most tricky phase. That's when inflation unexpectedly, for the majority, unexpectedly, shoots up. And that's the period you have to be careful about. That's the inflation shock. After it shoots up, phase 3, it stays high, and then phase 4, it normalizes, it goes down. Again, each phase is different and needs a different strategic response, whether you are an investor or a CEO. It's probably quite the same dynamic that you will experience. Now let's look in the 1970s what happened. In 1973, we got this inflation shock. Unexpectedly, inflation shot up, and you see what happened. GDP collapsed into a recession. We had 2 years of a recession. We had unemployment rate going up, and we had interest rate going up. And the stock market lost almost 50% of its value. Now, the 1970s are very tricky because they were a little bit different from previous inflation periods because they had a second inflation shock. So inflation went up, came down, and then went up again. And the second shock was much more severe than the first shock. Again, the same pattern, recession, unemployment rate went up even more than during the first shock. But now you see the stock market went up. Keep in mind, the second inflation shock, that was the period when Volcker, the chair of the Federal Reserve, lifted interest rates, the federal funds rate, to over 20%. And even though the stock market had a positive reaction, we have to look at this in a more detailed view. Now here are the 2 inflation shocks again. First time, 50% down. Second time, 17% up. How can we explain it? Well, it's quite simple, and that will teach us a lot for today's time. The first inflation shock was when nobody was prepared for it. No one had experience managing inflation, except Warren Buffett, who did spectacularly well during that period. But most people and most CEOs, politicians, central bankers were caught unprepared. The S&P 500 reflected that unpreparedness. The price earnings ratio was almost 20. before the first inflation shock. And then it came down to 7.5. In the second inflation shock, two things were different. Stocks were already reasonably priced, or actually cheap, at 8.6 in December 1977 for the price-earning ratio, and management and central bankers had a little bit more experience with what works and what doesn't work. And that helped companies to do much better during the second inflation shock, and that's reflected in the reaction of the stock market. But now is an important point. Is the stock market a perfect inflation hedge? If it was, it has to beat inflation. It has to help you to protect your purchasing power with your investments. Now, in the first inflation shock, if the stock market was a good inflation hedge, it should have reached a break-even level of inflation. So basically, if you start at 119, it should have gone up to 142 to beat inflation, to basically make you break even, that you protect your purchasing power. Only if you're above the line, you made money. You see very quickly that wasn't the case. And now we look at the second inflation shock, the same. There was a performance gap. Even in the second even during the second inflation shock, the stock market did not beat inflation. So it helped a little bit to protect purchasing power, and it did much better than some other investments, but it was not a perfect inflation hedge. Now, you might ask, how was it during the whole inflation period from 1973, 1982? I have a different video on this, but I can tell you, even over the long period, and even if you include dividends, the stock market over that almost 10-year period did not beat inflation. So, judging from the 1970s, it was not a perfect inflation hedge. Thank you very much. If you have any questions, put them in the comments. Thank you.